Good morning, everybody. Happy Tuesday. And today is the eve of learning what the Fed's going to do with interest rates. We're going to get the Fed's decision tomorrow. Now, I know the market is now predicting a 65% chance of a 50 basis points cut. Really, it had been 50-50 up until the last couple of days. Personally, I think the Fed's going to do a 25 basis point cut, but I also think they're going to come with a pretty strong signal of aggressive cuts to come, both of the next two meetings and into next year. And in truth, it really doesn't matter what the Fed does tomorrow, whether it's a 25 basis point cut or a 50 basis points cut. Both of those possibilities have already been priced into the market. So we're not going to see mortgage rates improve with just because of the Fed cut. However, the bond market will be swayed by future signals. So if the Fed says that they're going to aggressively cut in the future, then you're going to see mortgage interest rates improve. It really just depends on what they say. And so I'd rather see a smaller cut with stronger signal versus a larger cut with a weak signal, if that makes sense. Now, the Fed hasn't really clearly communicated a 50 basis points cut, so that's why I don't think they're going to do it. The Fed whisperer, Nick Timmerman, has been saying the Fed is 50-50. I don't know if the Fed knows what they're going to do, which is why they're hedging their bets. Typically, the Fed doesn't like when the market isn't sure what they're going to do, but I would say a 25 basis points cut. If you're asking me, 25 basis points cut. And that's probably the right thing to do right now, as long as that they communicate, that they're going to be aggressive in the future. And as we talk about interest rates, that gets me to Tech Tuesdays. On Tuesdays, I like to talk about technology, how to use technology, the future of technology. And so on Tech Tuesday today, I have an interesting topic, and I don't have reference material. I'm just going to share some insights. I met with a market intelligence provider last week, and so market intelligence. If you're a loan officer, market intelligence gives you information about real estate agents. It gives you information about loan officers. It gives you information about competing companies. That's what market intelligence does. They go out there and they just tell you, here's data about the market. And as you're all well aware, the whole market intelligence arena has been evolving dramatically over the last couple of years. And now, with the advent of AI, they'll be able to data mine that much more powerfully. So, as we know, one of the things that's happened in the last couple of years, when a loan officer leaves a company, they no longer have to bring their database, because using market intelligence, these market intelligence companies can rebuild the database for them, right? So now we know who your past clients are, right? It's public information. And so these market intelligence providers, if I'm a loan officer and I go from company A to company B, I can leave my database behind. I don't have to worry about it, because these market intelligence providers can rebuild my database. Now, they can't get me all the proprietary information. They can't get me all the personal information. They're not going to get me the borrower's social security number. They're not going to get me necessarily their FICO scores. They may or may not be able to give me the interest rate, but they're going to be able to tell what customers I served, and they're going to be able to provide contact information to those customers. We already all know that, and I'm sure where you're at, they provide that. But here's what's coming, and this is what goes to the label of my talk, why I believe that almost every mortgage company will offer the very same rate in the future, or very similar rates. And I put it, and the way I put it is, I believe that we're going to have a very homogenized interest rate in the future, and here's why. Today, what happens, we fight up front. We fight up front to win a deal. We get a lead. Oftentimes, we compete for the lead. We try to be the most competitive. We try to offer the most value. And then we close the deal, and we think we have the client. And for the most part, we do. And then if we nurture and feed and support that person, we have the right to possibly earning that relationship ongoing. But and so we really think the demarcation or the delineation is, we get a lead and we close it, right? And then we feel that there's some security. Now, what happens if the market moves radically, or if we got that lead in a forced environment where we didn't give a market rate, then we're at risk of losing that client to an EPO or an early payoff. And so, depending on who you're selling to and what your covenants are, let's just say that the loan pays off in 6 months. Well, that loan hasn't performed. And so both the loan officer and the company are typically charged back for the fees that they received in that loan because the loan didn't perform. And so typically, oftentimes, the loan officer has to give up their commission because the company you sell to pulls it back, and then your company has to pay other fees and penalties, and it's not a good thing. EPOs are really bad, but they've pretty much just been restricted to, though, if for whatever the circumstance where we give a high rate and the borrower can subsequently get a better rate, and the borrower knows, like the borrower has loud signals that they could have a better rate. Now, conditions where that normally happens is oftentimes the rates improve, right? We close a loan at 6.5%. The bond market, MBS market radically improves, maybe improves by 0.5 point in a short amount of time. There's a ton of news about it, and so our clients are educated by all this information, and they go, "Gosh, I can lower my interest rate," and so they seek out a refinance well below that 6-month term, and then we have an EPO, which is really bad. There's some other circumstances where we expose ourselves to EPOs. A lot of times when we have a captured relationship, let's say that we have a JV where we have to generate artificial profits for both partners, and that forces us to push the rate up. And then other times when we're exposed to rate, when we do no cost loans where we finance all the costs into the rate, we might finance 2 or 3 points into the rate, which increases the interest rate by a point or whatever, and subsequently a competitor can come and do a rate and term, like a streamlined refi at no cost, and really lower that rate. So there's some ways that we expose ourselves to EPOs. Here's what's going to happen. This is where we get into the techie part of the future. Both of those scenarios that I just outlined, or those scenarios with EPO, rapid change in the marketplace, where we have a forced relationship and the client may or may not even like us, but we're forced to have a higher rate. Think builder relationships. Sometimes as a builder rep, you have to have a higher rate because the builder, you have to give the builder, maybe the builder's forcing you to do lender concessions, and maybe they're forcing you to, you're in an MSA or a JV and you have to deliver X amount of profit. The only way you get that is by building into the margin. The builder forces the buyer to use the builder rep. The buyer doesn't really like the builder rep. They'd rather use their son Johnny. And so as soon as they close, now knowing that they have a high rate, they refinance out of it. But those are the limited conditions which usually face EPOs. But in the future, here's what's going to happen. In the future, your competitors are going to know the rate you closed at. And so if you if you have a high comp, or if your company is inefficient and has a high rate, or if they're just highly profitable and have a high margin, that's going to be totally exposed. And so let's say I'm a loan officer in a market, let's say I'm in Colorado, and I want 150 basis points comp, but the market really has 100 basis points comp. And so I'm 50 basis points high, my 50 basis points, my interest rate is 50 basis points higher than my competition. And then let's say that my company is inefficient and we have, our processors are closing 3 loans a month, our underwriters are only touching 5 files, and so we have a really high operational cost, and so that forces our rates up even higher. And then let's say the company says, hey, I am mandated, I've got to make at least 50 basis points. Well, all that would lead me to have an interest rate that is way higher than the market, way higher. In that scenario, each of those things, inefficient operations, too high of loan officer comp, too high a margin for the company, each of those can tack on anywhere from 1/8 to 0.5 point to interest rate, right? I mean, they're toxic. Well, in the future, what happens is I'm going to know that. I'm gonna be able to start understanding how you specifically price, you my competitor, whether you're a company or a loan officer. And here's how I'm gonna know it. Now, what happens, some counties, some municipalities record interest rate. So one is public information. It's just learning how to data mine the public information. And these market intelligence companies are getting better at data mining. They're getting much better at it. But not all municipalities, not all counties, capture interest rate. It doesn't matter, because what's going to happen is that the pricing engines that people price in are going to sell autonomized data. When I say autonomized, in the future we're going to be able to go to these these POS systems and to these pricing engines and buy data, because that's what they're about, selling data, right? So I'm going to be able to go, hey, how does ABC price compare to the market, right? Just on average, just autonomized, how does ABC Mortgage, how do they price on Tuesday the 5th compared to the market? And they can say, hey, they price on average 37 basis points higher than the market, or 50 basis points, or whatever it happens to be. Then I can take that information and I can compare it to what the market rate was that day. And I can just use an average of the market rate that day. So I can look at your company's pricing behavior, I can look at the individual's pricing behavior, and I can look at just a average rate. And with pretty good confidence, I can tell you what rate you pick for your customer. Now that I know what rate you pick for your customer, I know how to steal your customer. Because let's say that you're slightly high. Let's say the market's at 6% and you're at 6 3/8. I know how to beat you. I know how to get that client. I know how to call your client and go, hey, look, your lender is a terrific lender. They offer really good service, but historically their rates are kind of high. And what I find is I can typically improve their clients' interest rates by a half a point at no cost to the borrower. Would you be interested if I could lower your monthly payment by $264 at no cost to you? Right? I can get very specific about how I approach my competitor's client because, what I just suggested to you is pretty much available. It's going to get pinpointed. It is going to get exact. And what that means is that I now have to defend my lead through close as a loan forever. I have to protect that loan. I cannot have the luxury of coming in with a high rate. If I come with a high rate, if I have high comp, and those three things that create a high rate: high comp, inefficient operations, or too high a company, profit goal, margins, right? If any of those things exist, my competition will know. They're going to get, that database of customers. They're going to get really good information, and they're going to attack that database, which is going to create painful EPOs. And when this starts happening, companies' their only defense is to put out the same rate as everybody else. Same thing with loan officers. Have the same comp, relatively the same comp, have relatively the same rate. And that's how we're going to get to a homogenized rate. Now, of course, some people offer more value, some people offer more services, some people can charge more. You'll have to determine what you can charge, but what you'll have to say is, look, my rate on average is an eighth of a point higher than the market, and here's why, or a quarter point higher than the market, and here's why. And here's the problem. Because when we talk about a market rate, we talk a market rate where everybody's charging full fare. But remember, when somebody's trying to pick off one of my loans, they can cut their margins, they can cut their comp. I mean, they can do what they want to win. So we don't have a lot of upside to be casual about adding on rate. And so I think in the future, almost every company is going to offer the same rate. Every company is going to offer the same rate. Now, some companies will be willing to work for free. The rational companies won't be able to compete, but the people that want to work for free won't be in business long. There's no incentive to be in business if you work for free. So the people who want to work for free, you gotta let them work for free and let them leave the business, right? But all we can do is just do the best rate we can, but just know the battle over that lead is now going to go well past close. Interesting concept. I know a lot of us don't like to think of it that way. It's interesting. We didn't know. I can just tell you everything's changing. Everything is changing, and mass data is changing. And then not only mass data, not only because a lot of times we've had data, but what AI does, what machine learning does, what all allows us is now to deploy that data in a useful way, right? Having these massive mega data, right, centers, if we can't sift through it and make something reasonable out of it, well, now they can in a very, very pinpoint way. So in the future, you'll know if my rates are high. You'll know if my clients are ripe for a refi. And as you know, with salespeople, they're not generous. They're going to go after that client. So just think about it as you start to strategize about the future. Figure out how you're going to put out a market rate. A market rate meaning not I'm with an eyesight, meaning I'm competitive, I have a good rate, I'm not exposed to what I'm detailing. Anyway, that's Tech Tuesday. It's a terrific week. It's good. You can see I'm back here in Scottsdale. It's great to be in Scottsdale. I went out for my hike this morning, and I swear it was in like the high 60s, low 70s. I'm like, what the heck happened? It's like fall here all of a sudden. Matter of fact, I think yesterday was first day under 100 in 108 days or something like that. Times are changing. Seasons are changing. Everything's changing. Change is good. Change is opportunity. All right, everybody. Thanks if you check me out. Thanks for listening. Can't wait to see what the Fed does tomorrow. I'm guessing 25 basis points. Regardless, what's most important is our signals. And aside from that, just know in the future, we're all going to have to throw out the same rate. That's what you're to hear. Thanks. Have a great day. I'll talk to you soon. Bye.